why the Reserve Bank won't stop until inflation is under control, and what will happen when all these fixed rates come to an end. We've got Martin North here today with us to help clear up a lot of mixed messages we're seeing in the market at the moment. This is a 3-part series to hopefully help that uncertainty that you might have. If you haven't already, check out the first video we did with Martin, link in the description. So Martin, what type of support should be in place for those priced out of the market?
Well, I think there is some sort of stop doing stuff and start doing stuff. So it's interesting. The Productivity Commission came out the other week and said, oi, all these first owner grants that you've been thrown around the place, both federally and state, stop it. Because all you're doing is just driving properties higher. You're driving prices higher for those people who were already at some stage going to be able to afford to get into the property. What you should be doing is redirecting all of that funding, and it's about 3 to 4 billion over recent years for first owner grants. That should have been put back into the rental sector to help people who have real housing issues, and it's not just affordability. They've got no access to housing. And they sort of made the point that, well, really housing, it should be a social right. It shouldn't be just based on whether you can afford it or not. So that's, I think, an interesting observation about putting some supports in place, particularly to help those who are unable to get any sort of accommodation. The second is, over the last 30 years, the public sector investment in housing has gone through the floor. Most of it just been chucked across to the private sector, to property investors, and basically the governments have said, we'll outsource all of that to property investors and we'll give them a bit of a tax break and she'll be right. But unfortunately, as you say, the total pool of properties for rent is dropping. The average rental increase for new rents at the moment are somewhere between 10 and 20%, depending on where you look. So people are finding huge amounts of difficulty being able to afford to rent anywhere if you can find anywhere. And so the whole system is broken. I think we have to talk sensibly about social housing. And I think there's a very important role of government, both state and federal, to think about how we actually deal with social housing. And then I guess the third question is there an opportunity to change the formulation around the way that property investors work so that effectively we can perhaps encourage a few more people to want to put their properties back into the system? Because the other thing that we've seen is a lot of people have actually switched to Airbnb. So rather than actually long-term leases for people so they can go and live in the house, property investors are saying, well, I'll just let my property out, peak season, few days a year. It's a lower impact on the property, so it doesn't wear out as much. I get a significantly higher return. So I think, hard to know, but I reckon there's 350 to 400,000 Airbnb properties across the country. I think we need to look at that, because I actually have a real problem with that approach, bearing in mind that we have a housing problem, particularly rental one. So I will be looking at some of the Airbnbs. We need to get better information on who are actually running Airbnb properties. They should be, I think, taxed as commercial businesses rather than actually not, because at the moment, a lot of people don't declare perhaps what they should declare. So I think those are some of the policy issues. I think the other factor we've got to come to is that we can't go on extending the income multiples for households just so they get in the property market. So we have to, actually, I think property values going back would be quite helpful, because it would help people to perhaps afford a little more. At the moment, many people are having to put up 40, 45, or even 50% of their disposable income just to get a place to live. And that's really not good policy, because it's sucking a lot of action out of the rest of the economy. So, there's a few things there, but this is a really intractable problem. It's a structural problem. It's not just going to go away on its own. We need action at the federal and the state level, I think, in a coordinated fashion. And we can't just say it's a supply problem, because it's not. There's more than a million vacant properties across the country at the moment, and maybe they're not in the right place or the right type of property. But it's a much more structural issue, and it's a social issue, and it's an economic issue that we need to get to the bottom of.
100%. And we see 1/4 of mortgages they're currently fixed in. So of all mortgages, about 1/4 is fixed in. A lot of them are actually coming up off their fixed rates in the next year or so. How do you think this is actually going to impact the market with all these fixed rates? A lot of them were fixed in at 1.99%. Great rates at the time. Probably listened to the Reserve Bank governor and thought that rates weren't going to change. Now they're going to be finding they're coming off on a 4-5% rate. It's going to feel a lot of mortgage pain. What do you think that looks like for the market?
It's going to be a pretty shocking. It's a bit like the adjustable rate loan problem that they had in the US at the start of the global financial crisis, where effectively people were on low rates and then they had to refinance to a higher rate and they were unable to do that. Now, there is, as you say, about 25% of mortgages at the moment on a fixed rate. The peak actually will be in the first half of next year, because a lot of people were on 2 or 3 fixed rates, and they're coming. And in some cases, they're going to go from, as you say, under 2% to maybe 5 or 6 or maybe even 7. The other point is, of course, banks will be obliged to apply the current underwriting standards to those new loans, which means a 3% buffer on the current mortgage rate. So it'll be very interesting to see whether the people who are on those fixed rates now can afford to get now the next mortgage, or whether in fact they will fall foul of the underwriting standards, and what will they do then? So I'm expecting to see some people being forced to sell because of that, or at very least, if you can get a mortgage, and the rule of thumb is for a 30-year mortgage, every 1% on interest rate up over 30 years is equivalent to a 15% monthly increase in the payment. So that means that you could be looking at a 50% uplift in your payment. Plus, of course, you're probably now not going to be on an interest only, but principal interest. So that could be another issue too for many people. So I think this is a really big problem. And that's another reason why I would argue that there might be downward pressure rather than upward pressure on prices next year.
Definitely. And we see that if the cash rate gets to 3.5%, it's been said that 25% of all variable home loan customers would be paying about 30% of their income towards their mortgage. And this would see their buffers get wiped out. We know the Reserve Bank has talked a lot about borrowers and their buffers and, having that as a cushion or a fallback. If we see, borrowers' buffers get wiped up, do you think that'll be put more pressure on the Reserve Bank to bring down rates?
I don't think the Reserve Bank can bring down rates while inflation is high. So it's very clear that Lowe is saying that dealing with inflation is the most critical thing on their agenda. And look, central banks around the world are saying that. And that's because if you have high inflation, everybody loses, because the value of your savings go down. You end up chasing your own tail, just trying to cover your expenditures. RBA is going to have to continue to lift rates until inflation gets back within its target band. Now, the rate at which they do it might be slower than in some other parts of the world, but they can't turn around and say, I'm going to cut rates. Because if they do that and inflation is still not conquered, it'll go through the roof. And the experience of the 70s and the 80s was that once inflation got embedded and ingrained, it destroyed economies, destroyed livelihoods, and lifted unemployment rates. So I'm afraid the RBA has no choice but to execute what it's currently doing. And by the way, it's also following the Fed and the RBNZ in New Zealand and the Bank of England and even the ECB. They're all doing it. So if you move too far out of step and if you start taking interest rates lower, that's then going to slay the exchange rate. Exchange rate's currently sitting at 62 to the US, right? It was at 70 something last year. That's a significant depreciation. And the problem there is you then start importing more inflation because, of course, we buy oil in US dollars, which means we're going to be paying a lot more for oil because of the local exchange rate differential. So if they let the interest rates stay too low relative to international peers, it's just going to put more inflationary pressure on, which means it comes back to my further argument. They've got to conquer inflation. So I don't think they can turn it around. And I know that there'll be, in fact, Wayne Byres the other day giving evidence towards Parliament said he knows that some people are going to have problems. Phil Lowe's pretty much said the same. And their generic conversation about lots of people got boppers. Well, some do, absolutely, some do, but a lot don't. And unfortunately, what I'm seeing in my numbers is that there's about 30% who have no buffers at all and are already living hand to mouth when it comes to servicing their mortgages. There's another third that are sort of getting to the point where they're going to have to actually think quite differently about how they spend. There's a third that are absolutely fine and would be fine if rates go up to sort of 7, 8, 9%. So it's very variable across the household cohorts. And I sometimes feel that the RBA and APRA talk too generically about what's going on rather than looking at specific households. Unfortunately, many specific households already finding it quite tough.
This concludes part 2 of our 3-part series. If you missed the first video, link in the description below. In the next video, we're going to continue in trying to get some clarity on where the market is going. So join us, hit that subscribe button down below to keep up to date, and when the next video is posted, you'll be aware and across the details. And guys, thanks for watching.